Hey everyone, today we're going to be going through an accretion dilution beginner's tutorial, and in today's video we're going to be going over an overview of what accretion dilution is, and then the 5 steps towards building a model, and then some advanced topics that I'll go through in future videos. Just to really show you what we're going to be going through, this is the model which you can download for free in the link down in the description below. It's a very basic accretion dilution model, and in future videos I'm going to have more advanced ones. So this is just a beginner one. Before getting started, I wanted to let you guys know about today's sponsor for the video, Wall Street Prep, who with Wharton is offering an applied value investing certificate program. It's an 8-week long course where you learn at your own pace online, and you're learning all about value investing, which is the investment philosophy that Warren Buffett is famously known for. Basically, the point is to learn how to identify undervalued stocks. They work with a lot of different other companies, and there's a lot of different speakers, as you can see here, that you'll learn from, including Wharton professors and a lot of keynote speakers from real investment firms, including Howard Marks, who is the co-founder of Oaktree. He's kind of just a legendary investor. And so you can see there are a ton of speakers, and in terms of what you're going to actually learn, there's an intro to value investing, market efficiency, you scroll up here, intrinsic value, institutional grade investing, and a whole lot more. And then another thing that I think is really interesting about the program is that first, a lot of the applicants are people who are already working in finance. And so there's an opportunity to just kind of connect with them a lot, because there is a global network where through all of these certificate programs that Wharton and Wall Street Prep work on together, you can kind of join events and a LinkedIn group where you can kind of connect with everyone. So I think it's just a good opportunity to network with a lot of people as well. So feel free to check them out. You can use my link in the description and use the code rareliquid to get up to $500 off. And with that said, let's go back into the video. So today we're going to be first going over an overview of what accretion dilution is. So very simply, it involves an analysis that compares the increase or decrease of earnings per share after an acquisition. So very simply, standalone, the company before they acquire another company, what is their EPS? If it's less than pro forma, meaning after the acquisitions, that EPS, then it's accretive, versus if the company by itself before the acquisition, if their EPS is higher than the combined company's EPS, then the acquisition is known as dilutive. And if this is your first time coming across these topics, then all of this is going to become very, very clear very soon. But first, let's talk about why investors even care about accretion dilution. So public companies are often judged by analysts and investors on their ability to grow and sustain their earnings, aka their net income. And earnings per share, EPS, is just your net income divided by your number of shares. So companies, when they are purchasing another company, think about if you're running a multi-billion-dollar company or $150 million company, and you were trying to buy another one, right? Regardless of the scale of the transaction, it's a large investment that you're making that's potentially a little bit risky. And so you need the optics to look as good as possible, especially the larger you are as a company, and especially when you're public, because when you think about your earnings per share, that is a key metric that all investors and equity research analysts really look at to analyze the effectiveness of a transaction. Because ultimately, for any given company, the real value that you generate is how much you're able to earn, right? So if you're buying another company and your earnings per share, your operational and profit efficiency in a sense is going up, then that's great. And if it's not, then that's bad, right? And so if you're able to acquire a company and it's accretive, then things look good. Your stock may go up, employee morale, all of that stuff, executive compensation, everything is good if something's accretive for the most part. With that said, a lot of times acquisitions are made for dilutive, or some acquisitions are dilutive, and that can be okay as well as long as there's strong rationale. So it's not whether or not purely if a deal is accretive or dilutive. To give you an example, Facebook bought Instagram for $1 billion many, many years ago, and Instagram at that time had zero earnings, right? And so that was dilutive, but now Instagram is worth several hundred billions dollars. So that was a great transaction for Facebook. But with that said, for the most part, especially the more mature a company is, accretive acquisitions are very, very important. Investment banks are tasked with identifying the most advantageous acquisition structure by modeling various assumptions and evaluating their financial impact to EPS. This is what we're going to be going through. There's a lot of different assumptions we're going to be discussing today, and you're going to see how they all impact your earnings per share. Just to give you guys another example, so this is a deal that I actually worked on, $6 billion deal where Cardinal Health acquired a $6 billion divested asset from Medtronic. And you can see on the right here, this is a press release that my team and I actually had to kind of edit. But you can see here that it says GAAP diluted earnings per share from continuing operations was accretive by more than 21 cents per share. And then there's other things like $100 million of inventory step-up costs, which is related to synergies, I believe. And then incremental annual financing. So there's a bunch of things, but the main point is that in a press release, whenever a transaction is announced, usually there is some mention to earnings per share if it's a public company. So next, you may be watching this because you are going to interview at an investment bank, and a very common question is, how do you build an accretion dilution model? So verbatim, this is what I would say in an answer. So first, you determine the purchase price and how the deal will be funded through cash, debt, and stock. You then project the standalone financials for the buyer and seller. Then you combine the two income statements and adjust for acquisition effects, such as synergies, new interest expense, and foregone interest on cash, all things we're going to discuss later, and calculate the combined net income. Finally, divide by the new share count to get the combined EPS and compare it to the buyer's standalone EPS to see if it's accretive or dilutive. So this is an overview also of what we're going to be going over today. Very simple answer though, for if you were to explain it to a 5-year-old, is a merger model, which is the same thing as an accretion dilution model, compares the EPS of the standalone versus combined company. So that's an overview of the of what accretion dilution is. And next we're going to go into the 5 steps, and we're going to be jumping back and forth with this PowerPoint and then the Excel here. So what I do recommend is, if you are watching this right now, download the Excel so that you can follow along, or you can do that a little bit later, up to you. So let's first go through an overview of the 5 steps of building a merger model. First step is to determine the purchase price and method. So how much are you buying the company for, and how are you funding the transaction? Next, gather all your transaction assumptions, because there are additional fees and things you're going to need to pay in any given transaction. Then the pro forma balance sheet, pro forma income statement. This is basically you combining 2 companies together and all of their financials. And then lastly, accretion dilution calculations, which is super, super easy. So first, let's go over conceptually determining the purchase price and method, what all this means. So the purchase price is the amount that the target company is being acquired for and is an input assumption. So if you watched my previous DCF videos in the past or trading comps, if you just know about valuation overall, you do a lot of work to see what is the value of a company, what should I pay for that company? And usually that is your output, right? You're trying to get to valuation. But for purchase price for an accretion dilution model, the amount you're paying for a company, what you're valuing that company as, is actually an input assumption for the model, as you'll see. Next, consideration is the way that an acquirer pays for a target, typically through cash, debt, or stock. And let's go into each of these, because this is really kind of near the or at the crux of what is really important when you're building an accretion dilution model. So cash reduces the excess cash on the balance sheet. So imagine if you had $100 million in cash and you're buying a company for $50 million, then you're literally spending $50 million of your excess cash that you don't need to operate the business with, and you're lowering your cash on your balance sheet, right? And this has a significant impact, or a meaningful impact, I should say, on your income statement, because when you normally have cash, you can put it in a high yield savings account, company version of that basically, and you can earn interest on that cash, right? But if you spend that cash, then you're not able to earn that interest income. So that is something you need to account for. You can also raise debt to purchase a company. I think this one's fairly intuitive, like raise $100 million to buy a $100 million company. So it increases debt on the balance sheet, and it also introduces interest payments that you need to make. So that lowers your net income as well. And then stock, this one's, I guess, slightly the most trickiest, but you're basically issuing, you're paying, you're giving the target company shares of your own company. So that affects your balance sheet, and also it increases your number of shares because you're issuing new shares. And so this lowers the denominator in earnings per share. So if you're normally at $100 in earnings and then 100 shares, that's an earnings per share of 1. But then if you issue stock and you're at $100 in earnings and then 100, let's say 200 shares, then that's 0.5. So 50 cents in earnings per share, right? So this is the first step. Let's go into the Excel now to show you what this all looks like. And again, this is a very, very simple model because I want you guys, if this is your first time, to just understand what everything is from a fundamental standpoint. And later I'll make videos about more advanced merger models. So as you can see here, the offer price, we have the share price, offer premium. So offer price is just your share price times 1 plus your offer premium. So that gets us to $125 per share. We have 50 shares outstanding. So your purchase price is just your offer price times your shares. And so you're purchasing the company for $6.25 billion. Everything here is in millions. And then we just have a figure here that your earnings per share is $3.50. And then you have something here, consideration, right? So all of this will come into play later. But one thing I just wanted to do here was we have stock and debt as 33.3% each. And then so for cash, all we need to do is 1 minus the sum of the other two here. And this makes it so that if this is like 20%, then this is, turns into 46.7%. One thing I would be careful of is this model is not perfect. If you put 50 here and like 60 here, then you have negative 10% here. Obviously, you can't do that. So normally in a more advanced model, I'd make sure that there would be some kind of error if that happens. But in our purposes, just make sure that these two don't go over 100, basically. So very simply, we have the stock, debt, and cash figures. And then we will jump back now into the PowerPoint to discuss gathering transaction assumptions. So there are a ton of different assumptions in a full-fledged model that you need to build, but let's go through some of the basic ones. So first, of course, you need to gather historical and projected financials and use this to compare your standalone versus pro forma EPS, which we will do in the future. Tax rate, you use your buyer's tax rate because once the combined company is one entity, so when two companies merge and one target gets acquired, then the buyer, the new company, is going to use not like sometimes a slightly blended tax rate, but for the most part, the buyer's tax rate is going to be what's important, right? So if a $1 billion company buys a $5 million company, that $5 million company gets like soaked into that buyer, and then sucked into that buyer, I should say, and then when that buyer needs to pay taxes, they're going to use their own tax rate, right? They're not going to use the smaller company's tax rate. Next, transaction fees. So there's legal, financing for like if you're raising any debt, banker fees if you're working with banks during like the M&A transaction. Interest rate on cash, we discussed this before. The rate at which you would be earning interest income on your cash balance. Interest rate on debt, annual payments that you would pay to debt investors. And then you want to create a sources and uses table, similar to an LBO, but you want to see where the amounts of the funds that you're using to purchase a target and then also pay for the target. So let's go into all of these when we're gathering transaction assumptions. And you can see a lot of these are already kind of in here. So the tax rate is 20%. Interest rate on cash is here, 1.5%. Debt, 5 years term, 7% interest. And then down here, we can start building out our sources and uses table a little bit. So the first thing that I want to do is talk about the shares that are being issued. So we're thinking about the amount of new shares a company needs to issue. Then what we have to do is get our purchase price. This is how much you're buying the company for. And then you divide by your share price, right? So you can see here, this 12.5 million shares need to be issued. Just to make this super crystal clear, if I multiply the share price times the number of shares issued, 6.25 billion. So you can see that this captures the entire value of purchasing this company, right? But of course, we have not 100% in stock that we're paying, right? So we have to actually multiply this by 33.3% here. So we're issuing 4.2 million shares. But of course, if we made this 100%, made this 0%, then it's the 12.5 million. But since we are only issuing a third of the purchase price in stock, we're issuing 4.2 million shares. And then let's build out our sources and uses table a little bit. So let's start off with the uses of what are we purchasing the company for? What are we spending money on? So this is simply, we go up to our purchase price here of 6.25 billion. And then financing fees we have up here as well. Oh, sorry. Financing fees actually need to come up with on our own and make it an assumption. So I'm going to put 100 here in financing fees and then 75 in transaction fees. Let's call this 50 actually. So these are assumptions that, again, for financing fees, when you are purchasing debt, and then transaction fees, legal fees, like all that stuff. And then acquire stock issued. So this is the 4.2 million times your share price. Oops, I divided. So you're issuing $2.08 billion. Cash, we're going to use as an input. And then for debt, we're going to do debt times our purchase price here. Again, 2.08. And then the cash we're going to use as our plug. So our sources always must need to equal our uses. So you can see here our total sources is equal to our total uses. And then the cash here, we're going to use as a plug. So this total amount that we need to source in terms of total funds minus the sum of our other two ways of raising capital. So you can see here, even though we're spending 33% of our consideration is going to, about a third of our consideration is coming from stock in terms of the purchase price. You can see here I added a note, cash purchase price plus fees. So this captures the amount of cash you're using plus any of the additional fees here. One thing I will note as well, another slight imperfection with this model that I would fix in the future is that, let's say that our debt here is 0, then obviously financing fees should be 0 as well, because you're not actually financing anything. So that's something that I would change later as well. Just wanted to let you guys know about that. And then in terms of annual financing fee amortization. So this basically, when you have financing fees, you're not always going to take it as a one-hit cost right away. You'll actually amortize that cost. So what we want to do here is just get our financing fee of 100 and divide it by 5. So it's very similar, same thing to depreciation essentially. So now we pretty much have our transaction assumptions. One other thing I wanted to go over that's very, very important for accretion dilution models, though, is something called synergies. So this is kind of what it sounds like, benefits from the combination of two companies that are greater than the sum of their individual parts. So there are 3 types of synergies. There's cost synergies, the reduction of redundant expenses and operational inefficiencies. So let's say that we have Google and then they acquired Amazon, let's say. And these two companies have, you're aware, Google Cloud and then Amazon Web Services, AWS. And both of them are cloud services that are offered, right? And if you were to combine those companies, now you don't need 2 separate areas, or you probably need still a lot of like servers and stuff like that, but you can save a lot of costs by maybe putting everything in one. So you don't have to pay 2x rent. Maybe you're paying like 1.5x rent. And then maybe you have like a HR department. Instead of having 2 separate ones, now you can combine them and have half as many people. So instead of like 200 people, 100 people from each company. Now maybe you need like 150 people or 100 people. So that obviously saves costs. And so cost synergies are a big reason as to why a company might pursue a transaction. And then there's something called revenue synergies, ability to generate additional revenue opportunities. These are a lot harder to justify and come by. You may be able to put this into your model if you have a really good justification. So maybe you have two separate companies that by themselves, they can only sell their individual products. Let's say it's like a mattress company and a pillow company. But combined, they can like bundle them together and then increase their revenue, and they have really strong data for that. So typically a little bit harder to actually realize and not taken as seriously versus cost synergies, which are a lot easier to actually predict and execute on. Revenue synergies exist, but a little bit harder to justify. And then there are financial synergies. So changes in capital structure, such as improved access to capital markets. So you may have a smaller company that is not public, struggles to raise funds, or needs to pay really high cost of capital in order to issue equity. Now, maybe if they're in the combined company, which is a lot larger, and maybe they have a healthy stock, then they're able to issue stock and raise capital a lot more easily. And then lower borrowing costs. If you have a larger company, typically your interest rates are lower because you just have a lot more better relationships with banks. You're taking out larger sums of money, maybe have better cash flow, and then enhanced financial flexibility. You're just able to kind of financially engineer your company a little bit better if you're larger and just execute better in general. So we're not going to actually build out synergies too much. One thing I will note is in a more advanced model, your synergies, you don't actually get all of them in 1 year. You typically, if you have like, let's say 100 million in synergies expected, you get that over a period of a few years. So we're not going to really model anything with synergies, but I did want to show you that it is here in the assumptions section. And then next, we're going to talk about the pro forma balance sheet. So again, for this one, we're not going to go through an entire combining two balance sheets or anything like that, but I did want to go over some of the key important steps. So first step is to identify and value assets all at fair market value, just meaning when a company is purchasing another company, that smaller one may have all their balance sheet and all that, but the larger company, it's their responsibility to make sure that everything is listed fairly, right? Because a company may have listed, oh, we have $100 million in inventory, but after a deeper look, maybe it's only actually worth something like 25 million or 50 million. And so you want to make sure that everything is truly valued. Next, eliminate any intercompany transactions. So if there are any transactions, maybe these companies kind of do business a lot together, you want to prevent any double counting of revenues, expenses, anything across the three financial statements. Combine balance sheets. So you want to add together the similar accounts for the balance sheets of the acquiring and target companies. There's a lot, but I just listed a few: cash, inventory, accounts payable. You're literally smashing financial statements together, and the combined number is literally, if it's company A, 100 million in cash, company B, $50 million in cash, total combined company, $150 million in cash. And you're just creating this kind of combined balance sheet. Next is calculating your goodwill as the excess of the purchase price over the fair value of net identifiable assets. So this also slightly more advanced topic, but whenever you purchase another company, let's say they have $100 million in assets or something around there, and then you're actually purchasing the company for $150 million, there's a plug in the model that you're going to need to add. Because if you're purchasing the company for 150, but their assets are worth 100, your balance sheet's not going to balance. There's that 50 that you need to plug in, right? So then that 50 is something that's called goodwill, and that's known as the plug for your balance sheet. Then the last step is to eliminate the target's equity balance. So since you're paying out for the entire company, paying for all their equity, if you're buying 100% of the company, then you zero out their equity because it's gone, right? Like you are literally paying all of it off. And so that's kind of a high level overview. There's a lot more steps, but that's the high level overview of the pro forma balance sheet step. Again, we're not really going to do it, but I did have a section here to kind of show you a little bit of what it's, some semblance of what it's like. So asset right up here. So if we have book value of target assets, 100 million, fair market value of 250, then we have asset write-up of 150. And then we want to figure out what are incremental DNA expenses, right? So that's 150 divided by 15. So again, we're not going to take a one-time hit. Essentially, we're just going to depreciate it / amortize it over time, just like we did with our annual financing fee. And so with that, we have all of our assumptions. And then just if I scroll down here, you can see that we have the actual model itself. So let's go into the next step, which is the pro forma income statement. And just going to walk you through a few steps again. So the first step is to combine revenue and expense items. So similar to the balance sheet, you're just really smashing the two financial statements together. You're adding all the standard income statement line items of both the acquire and the target. Then you're adjusting for fair value adjustments. Anything to, as you're making adjustments in the balance sheet, you're going to need to make, like, let's say you say, oh, okay, depreciation, amortization, interest expenses, like all these things that we have need to add now when the companies are being combined together. We need to adjust for all those things. And then add synergies, remove fees. So synergies, if you have them, they actually add to your net income, because if you think about you're saving $100 million due to cost synergies, then that needs to actually add to your income, right? Any fees that you're paying, you need to actually pay off. And so let's go through the actual accretion dilution model. This is really kind of like the crux of the whole thing after you build out the assumptions. And you're going to see it's relatively easy. So for the acquire standalone net income, we have all the data we need here. Standalone net income is for our acquire, our number of shares multiplied by our earnings per share, right? Because earnings per share times your number of shares is simply your net income, your earnings. So we have 2.5 billion here. Then we want to get to our pre-tax income, which we can just back into by getting our standalone net income 1 minus our tax rate, 20%. And then for our target, we can basically do the same thing. We have our earnings per share here. We can multiply it by our number of shares. And then again, back into this, 1 minus our tax rate. And of course, the buyer and target are going to have different tax rates. But for our purposes, we're just going to assume the same tax rate. And then this is the part where you're literally just adding things together. Pro forma, your acquirer's net income plus your target, and then your pre-tax income, acquire plus target. So this is your pro forma combined pre-tax income. And then we have to make all of the adjustments, right? So we have interest expense from new debt. So we can calculate that by getting our new debt and multiply by our interest rate. Pretty simple. Foregone interest on cash, get our cash balance, multiply by our interest on cash that we would have earned if we had not spent this cash. Incremental DNA expense is up here at 10 million. Deal fees. So this is your transaction fees. Financing fees amortized is up here at 20 million. So again, we're not taking out the entire amount of the financing fees. We're amortizing it over time. And then plus synergies, we have up here at 75 million. Then we can calculate our pro forma pre-tax income. So we get our pre-tax income, I'm going to subtract the sum of all these adjustments here. So we're at 3.08 billion. Let me see if I did something wrong here. Nope, that's right. And then pro forma net income is, we just need to subtract out our taxes, right? So we get our pre-tax adjusted income multiplied by 1 minus our tax rate. That gets us to our pro forma net income. Pro forma shares now we have to calculate as well. So that is our acquired shares plus any newly issued shares. So we have our diluted share count and then add our shares issued. So we have 254 million shares. And so now we can calculate our net income. So again, very simply, that's our net income divided by our combined company's earnings per share. So we're at $9.71. Acquirer's standalone EPS is $10 here. We can use that as a reference. So now, even without doing any calculation, oh, actually, I should go into the last part. So accretion dilution calculation here. Sorry, I kind of jumped ahead. But as we just kind of discussed, your pro forma EPS is your combined net income divided by your acquired shares plus your shares issued, which we just did, right? We calculated our combined net income, and then we're divided by our new total amount of shares. And as I talked about before, if your standalone before acquisition EPS is lower than your combined company's EPS, then it's accretive. And then if your standalone EPS is higher than your pro forma EPS, then it's dilutive, right? So that's what we're doing right here. And you can see here our pro forma EPS, combined company's EPS is lower than our standalone EPS, right? So clearly this is a dilutive transaction. So we get our pro forma EPS, subtract out our standalone EPS, and you can see that our EPS is, or our transaction is dilutive by 29 cents. And so if you want to figure out how much it's dilutive by in certain percentages, just get our pro forma, divide by our standalone minus 1, 2.9%. So you can see this is a dilutive transaction by about 3%. And I think what's important to also kind of note is, how do my assumptions really affect my transaction, right? So let me actually add a reference here of accretive or dilutive, and let's see how the assumptions affect everything, right? So we go down here, we can use this as a reference, and you can see if I make this into 0% stock, the transaction is a little less dilutive, right? If I make this 0% debt, it's actually accretive. And so this is really what the companies are really paying banks for, is they want to see, based on the different assumptions we use, can we make the transaction more accretive or dilutive, and what actually makes most sense? And remember that it's not just about the transaction. Like maybe using just cash will make the deal accretive, but that could have long-term implications on your company because you can't use that cash for other things as well. So not just based on accretion dilution that the company will adjust their consideration accordingly, but it is a very meaningful way for companies to see what kind of impact will the transaction have on our EPS if we're using different types of funding. And one thing I also realized that I want to fix here is that I didn't add our synergies. So want to fix that. And then another thing that you can just see, if we increase our synergies, it should be more accretive, right? So if this is 250, you can see it's just increasing more and more. So that is the accretion dilution model in a nutshell. And again, you can download this model for free in the link in the description below. So going through some advanced topics that I will go through in future videos very briefly. So first is calculating fully diluted share count, which we need to use the treasury stock method for, to actually calculate the true number of shares for both companies. Sensitivity analysis. So when you're building out any type of model, you can never be 100% accurate with what you ultimately come up with, right? And so you have to be testing or showcasing to your client based on our different assumptions. And for accretion dilution, let's say we'll have different amounts of EPS. So that's something we'll build out later. Combining the balance sheets and making adjustments. This is probably the most complex part of an accretion dilution model. Contribution analysis, some analysis essentially to see how much is each company contributing based on different key financial metrics. And then exchange ratios, which has more to do with analyzing the amount of stock being used by the acquiring company. And so hope this was all helpful for all of you, and look forward to more in the future on accretion dilution. And if there's anything else you guys would like me to cover, let me know down in the comments. And thank you guys all for watching. Hope to catch you all in the next video.